And as we'll see in a little bit, that means the price keeps changing so that so trades can actually happen. So the big thing here again is what each of the bonds are set in stone until maturity, and then we have this constantly fluctuating market rate that we call the yield to maturity. Right? And the interplay between yield to maturity and coupon rate are going to tell us something about the price. We'll talk a little bit more about that. Any questions on that brief background on what a bond is?
So, did you lose money when you sold it there?
Yep. Look, I bought it. And again, though, I didn't, things just didn't work out for me. Right? It's not that I made a mistake. I bought the bond. Right, and on the day I bought it, I used all available information, and I paid the correct price for it. But then after I bought it, things just didn't go my way. Right, the market turned against me. Right, no one anticipated this was going to happen. There was a credit crisis, I didn't see that coming. Right, and all bonds got hit, so I had to take up. Now the thing is, again, the key here is I had a liquidity event, meaning I needed to raise cash. Right, I had to pay healthcare bills or whatever. Right. So I have to sell this bond now. I may want to keep holding it to see if it recovers, whatever, but I have to sell it right now. And the thing is, I can only sell it for whatever I can get from Robin because she has to get the return that she needs to make her happy. So yeah, I lost money on that. It was against me. And with Mario, I made money. Right? Now he's not necessarily upset about this because this is a trade. He wasn't involved on the other side. He didn't lose money. He's paying a fair price. As Robin's paying a fair price. She's not making any money either, right? She's paying a fair price for her asset, right? It's just the fact that I lost money here and I gained money there. So other questions? And we'll put some numbers to this and see how it plays out. All right, what about a stock? Right? So the bondholders are creditors of the firm, right? You loan that to them. You loan money to them. The stockholders are owners of the firm. Right? Small owners. Right? And so these owners, with this ownership, you get two basic rights. Let's be very clear. You do not get any right to say anything about the daily operations of the firm. Right? If you buy a share of Comcast, you may not drive down to Center City, go up to whatever floor it is, knock on Brian Roberts' door, and say, I've got some ideas about how to improve customer service. Right? Who's the CEO of that company. You may not do that. You don't have that right. The two rights that you have a control right and you have a cash flow right. Right? The control right reflects selecting who gets to actually make the day-to-day decisions of the firm. But actually in our system, you actually don't have a direct control right because we don't actually, if you're an owner, you don't get to vote on who's the CEO. You get to vote on the board of directors. Right? Those are your representatives who then have the obligation to hire, fire, and compensate the CEO. Right? So, at a firm's annual board meeting, right? Firms once a year, they have their board meeting, their annual shareholders meeting. They have their meeting where they then come, present their results. The 10K is released. They take questions from shareholders. They typically want to see how great things are going, right? There's an election held for the board of directors. Now, it used to be the case that the majority of large firms in this country had what we called classified or staggered boards, meaning that not everyone was up for election every year, but there's been a push in part of the governance reforms over the last 15 years or so to declassify these boards, so the majority of large companies in the U.S. now have annual elections, so everyone's up for a vote every single year. Does anyone know how elections work in corporations? Is it like a political election? We have a bunch of candidates that are out there campaigning for the seats. What's that? You vote your stock, right? So every share that you have in most companies is one share, one vote. There are some companies called dual class stock, but most companies have one share, one vote. The more shares you have, the more votes you get. You can do it by proxy, so you don't actually have to go to Omaha, Nebraska to attend the annual meeting to vote. You can fill something in. What about the actual candidacy? Right? So let's assume that the board has 9 board members. How many candidates will be up for those 9 seats typically? 1 each. There will be 9. Right? 9 seats, 9 candidates. That's what we got. You can say yay or nay. Right? We do not typically have competitive director elections. When I say typically, we're talking less than like 2% of the time. right? And those cases are where we typically get to what you may have heard as a proxy fight or a proxy battle, where you have some investor who's putting their own slate of candidates up, which is extremely expensive to do, and they're trying to get investors to vote for them. There's something going through right now, part of Dodd-Frank, there was something called proxy access, which was going to allow long-term large shareholders, someone like a Vanguard or a Fidelity that's owned the stock for, let's say, 3 years, and they own like 5% of the company, to be able to nominate some directors every so years. That was part of Dodd-Frank, and then the courts took that down and said it wasn't constitutional. So a lot of companies are now, this has actually been a big issue in 2015, a lot of companies are unilaterally introducing proxy access at their firms. So they're saying, look, if you're a long-term shareholder of the firm, you can put somebody up. So there's some change of brewing with this kind of one person, one seat. But for our purposes, that's typically what it is right now. So one person, one seat. If I have a vote, I can say yay or nay. Now, again, up until about 15 years ago, most large companies had what we call plurality voting, which meant if you got one vote, you won. And we're talking out of millions of shares. If you got one vote, you won because you weren't up against anybody, right? The majority of large U.S. companies have shifted to something called majority voting now, meaning that if you do not get at least 50% of the vote, it doesn't look good, and there is pressure for you to step down. A lot of this is non-binding. You actually don't have to step down, but in most cases, if a director doesn't get at least 50% of the votes, they step in, right? And then they have to find a replacement director that gets voted out. Okay. So you get to vote for these representatives, right? And these representatives then again get to hire, fire, and compensate the CEO. So they then select who the CEO is going to be. So if you don't like who the CEO is, and you feel the board is not representing you accurately, is that getting loud? Then you can get rid of the board, right? And that's really what a proxy fight is all about. If you want to control the company, you have to control the board. You control the board, you can put your CEO in place to do what you want to do. Yep.
Going back to agency law, a lot of times, the chairman of the board is the CEO.
That's again about the last 15 years. That's changed a lot. That's not as true as anymore. It still happens.
You have to.
I think it's down to about 20%, 25% of large U.S. companies have what we call CEO duality, where they serve as both the CEO and the chairman of the board of directors, right? Most companies have shifted to what we call an executive lead director, who's an independent director. So the chairman is no longer, the CEO is no longer chairman of the board. But again, there's so much to talk about, but there's issues on both sides there. That's a good question. There's issues on both sides, because it's not, with most of these governance reforms, it's not always clear cut what the best answer is. And it's hard, a lot of times these changes in regulations are kind of a blunt instrument. There are cases where if you have a lot of company-specific information, it's good to have what we call insiders on the board, like a CEO or CFO, because they can then tell the board about what's going on and why it's important. If you remove all those insiders, the board is all these independent people that don't understand what's going on and trying to make some decision about that, right? So it can kind of go both ways, but you can have a very domineering CEO as chairman, who then, sets the agenda, and there isn't much you can do about that, right? So it can cut both ways. We see a very large reduction in CEO duality over the last 15 years as well. A lot of this is since Sarbanes-Oxley, since then we see a big push from there, right? So as long as the board's representing the shareholders' interests, things tend to work out better, and again, there's been a lot of changes going on. The other thing that's happened the last couple years since Dodd-Frank, you have one other voting right. You get to vote on the CEO's pay now. We have something called say on pay. I think we're in the 3rd year of say on pay now. So again, this is a non-binding resolution, right? Every year, as part of the annual meeting, they put a vote up. Are you satisfied with the level and composition of the CEO's pay package? It's a yes, no, right? Vast majority, again, 90–95% of votes are yes. We're fine with this, right? But we have seen a non-trivial amount of firms where they get less than 70% yes. And that generally indicates investor dissatisfaction with the CEO pay policies. Again, it's non-binding. The CEO can say, I don't care, right? And they can continue to pay themselves or have the board pay them however they like. That's typically not what happens there, okay? And what we've seen even more, though, even though we see really high numbers, people thought, wow, this, this is really way too high, but people like, there's a lot of engagement that's happened. By having stay on pay, what happens before it comes up to a vote, the CEO and the company go to their large shareholders and talk to them and say, look, this is how we pay. What do you think about it? And there's a lot of behind the scenes where Fidelity, that owns 10% of the company, says, you're way out of line with what, how we're typically paying CEOs. And there are changes made proactively before it actually gets to a vote. So there's been a lot of effects with that new voting right, stay on pay. So that's your first right. You have this control right along with kind of a non-binding vote on CEO pay. And then your second right is a cash flow right? So you, as a stockholder, are a residual claimant on the firm, right? You get whatever is left, right? The firm does its operations, it generates a pile of cash, it pays all its bills, it pays its employees, it pays for the lights, it pays the government, it pays its bondholders, it pays everybody else that it owes, and whatever's left in that pile belongs to you, the shareholders, the owners of the firm, right? And you get to share in it, you get a proportional share. So whatever percent of the ownership you own, so if I own 1% of the company, I get 1% of that pile of cash, okay? But then it's up to the company, what do you do that? You actually get that cash directly paid to you, right? Is that cash returned to you as form of, what historically has been a dividend payment. That's what we call a direct cash flow, where the company pays direct cash to its investors, right? Now, the company has to make a decision. And now this becomes a decision of the board of directors. The board of directors makes a decision, do we pay that cash out to the investors or not, or do we reinvest it, right? And typically what this comes down to, from an investor's perspective, is can the company use that money better than I can use it myself? If the company has a bunch of projects that will deliver a high return, I want you to keep the money, fund those projects, and grow that cash, right? So you can think about Apple, right? Early on, or not early on, but Apple in the early 90s, in the early 2000s, when they had all these new gadgets coming out, making boatloads of money, never returned a cent of it, right? And investors were thrilled, right? You create this iPod, it makes a ton of cash, keep it. What, you want to make something else? Make a phone? Great, make a phone. It makes even more cash. You want to make an iPad? More cash, right? Just keep growing that pile of cash until you're the size of the 7th largest country in the world, or something like that in terms of cash flow, right? Just keep growing it. But at some point, the good ideas dry up. It happens to every company, right? Sometimes it's quicker than others. And when those good ideas start drying up, that's when investors start knocking at the door and say, oh, by the way, we want some of that cash back. And that's what we saw happening towards the later stages of Steve Jobs' career, where he refused to give any cash back. And then when he stepped down, when he passed away, Tim Cook has now changed the policy, and they have returned something like, or they're planning to return something like $100 billion, $130 billion in cash to investors. Right? So that cash is no longer to be reinvested, it's going to be returned. Now, we don't cry for them, they've got tons of cash, right? But a lot of that's going to be now paid out. And as I think Mike and I were talking about earlier, over the last, since 1980, there's been a big shift, and really in the last 20 years, from cash flow being paid out in share repurchases rather than dividends. So the other way that companies return cash, and Apple's doing this as well, they may pay a direct dividend, but they go into the market and actually buy back their shares. Right? So if Mike owns some of Apple's shares and they want to return cash, they go out there and say, look, we'll buy the shares back, and that goes cash into your pocket. And so that takes those shares out of the market and returns capital to investors. So we've seen a lot of share repurchases, an increase replacing dividends over the last 20 years or so. Right? Now, but again, if you own stock, you have a cash flow. So you own that, even if that money gets reinvested, right, that's still kind of your money, but you through the board of directors, elected to reinvest in it. Any questions? Right. So we can see the distinction between debt and equity here. Right? So if you're a debt holder, you have no ownership interest. Equity is ownership interest. Again, we got some interesting things happen. Once you loan the money to the company, you basically have no say on what they do with it in typical cases, right? If you don't feel comfortable with that as a bondholder, and especially if your company is in distress, you might attach what we call covenants to the bonds. And bond covenants then restrict what the company is actually able to do, right? And that, I think we're going to Sean's point here about having some covenants on Mr. Trump himself, which is a very extreme form of a covenant that goes beyond just the reach of the company, but to the personal use of some of those funds. But typically, a bondholder has nothing to do with it. They give the money to the company wants them to take a risky project, right? And they don't get paid back, so be it. There's not much they can do. Creditors don't have any voting rights. The common shareholders get to vote to elect the board of directors. Oh, and the other thing they get to vote on is a merger or an acquisition. If a company wants to take your company over, and so you will no longer be a separate entity, you get to vote on that, right? And there are thresholds at which they need a certain shareholder vote for the acquisition to go through. Those coupon payments, that interest on that debt, is considered a cost of doing business by the IRS. That's why on an income statement we see interest expense, right? It's tax deductible. Those dividend payments, if the board of directors elects to make them, are not. The IRS has deemed them not a cost of doing business, so dividends are not tax deductible, and thus what you hear the double taxation. Right? I'm an owner of the firm generates cash flow, that cash flow gets taxed. They return that cash flow to me as the owner, I pay taxes again on it, personal income taxes. So that money gets taxed twice before I get to use it. Right? If I'm a bondholder and I gave capital, they don't get taxed on that money. The interest that gets paid, that's tax deductible. There's no tax on that. I do get taxed when it comes to me, but only gets taxed once. Right? So we have a different tax regime for the equity holders and the bondholders. Right? And that's, again, we'll see that feeds into that weighted average cost of capital. That's why that debt side we saw there's a tax implication there, on the equity side there's not. If payments are missed to the creditors, they have legal recourse. They get to go to the courts and say, guess what, you're bankrupt, we get your assets. If a firm decides not to declare a dividend, too bad. Right? The bondholders say, we're not paying a dividend, you as a shareholder can sell your stock, but you can't have, there's no legal recourse. Really good example, BP, the Gulf oil spill. Right? BP is a British company, British Petroleum, and a lot of their shareholders were elderly people in Britain. Why was it? Well, because they owned it as a form of income. Right? During retirement, they would hold BP stock, and BP regularly paid these dividend payments. Right? This is a check that came in the mail. Right? And then the pipe exploded in the Gulf of Mexico, and they racked up $20 billion in liabilities if they don't have to pay, or whatever it was. And the U.S. government suggested to them that it may not be a good idea to continue making your dividend payments until you figured out all of your bills over here. And with that persuasion, they stopped. They stopped making dividend payments. And there was nothing that the little old grannies and grandpas over in England could do about that. It's a completely different legal system, but still, even in our country, they had nothing they could do about that. Now, after they set up their restitution funds with the Gulf, they then started paying dividend payments once again. But in the interim, there was nothing legally they could do. If you have too much debt, you go bankrupt. If you have an all-equity firm, in theory, you can't go bankrupt. Now, there are instances where if you have pension obligations, or nothing they can make you. They're like debt holders, right? But if you are an all-equity firm that hasn't borrowed money from anyone, you can fail, right? But you don't go bankrupt, right? No one pushes you into bankruptcy, right? Unless there's obligations out there that you have to pay, right? So these create different incentive structures. Okay. So again, there's a lot of interesting things to get into in the difference between debt and equity in terms of capital structure decisions, how to fund your firm, and so forth. We're not going to address all of those here, but they are definitely interesting. Your book talks a lot about them, so I would highly recommend looking into that when you have time. But what I want to talk about today is how we value these assets. How can we think about finding out the value of a bond and the value of a share of stock, and then what those valuation models can tell us about investors' required returns. Okay. Now, I do want to make the distinction. This is obviously a corporate finance class, not an investments class. And so we are not going to talk about the distinction between price and value. Right? But clearly, if you're trading in the market, the price at which you're able to buy, let's say, a stock, may not reflect its value. Right? There can be reasons where the price deviates from value. People see those as investment opportunities. There's a lot of varying views on why that happens. Could be because of psychological biases of investors and so forth, of why the price doesn't reflect value. We're not going to any of that right now. We're going to be talking about the intrinsic value of an asset. What is it actually worth in its ability to generate cash flows? Right? We're not going to talk about what the price you necessarily pay for it, because that brings in a whole host of other issues that don't directly relate to what we're talking about. Okay? So I want to, again, we're going to use the term value. I may use the term price, right? But we're going to always assume that price equals value. Markets are highly efficient. Price always equals value. Okay? Anyways, so when we're talking about these assets, whether we're talking about stocks or bonds, right, we have this primary principle that the value of a financial security is equal to the present value of its expected cash flows. You know what? That's the same principle we use when we talk about real assets. Forget financial assets. The value of an asset, regardless of if it's a financial asset, and when we talk about a financial asset, what we're really talking about is a claim on cash flows. Right? If you own a bond, you own a stock, you don't own anything tangible. You might have a certificate you can hang on the wall or something like that. But what do you actually have? You have a claim on the cash flows of the firm. So when the firm generates cash flows, that piece of paper, your security, says, I get some of those cash flows. That's what you're buying. A claim on the firm's cash flows. That's what a financial asset is. A real asset is you actually have something tangible. I have a truck, I have a grill, I have a plant, or something like that. Right? But regardless if we're talking about this claim on the cash flows or the actual asset that generates the cash flows, the value of that asset is equal to the present value of the expected cash flows associated with the asset. As we talked before, what do I care about? I own the asset, I invest in the asset because I believe it will generate cash flows for me. The way I find its value is by finding the present value of those cash flows at a certain point in time. So just like if we talked about real assets before, a project before, the two necessary ingredients that we need expected future cash flows, and we need a required return. Right? If I can have those two things, I can find the value of any financial security no matter how complex. It could be a bond, it could be a stock, it could be a derivative. Whatever it is, no matter how complex you want to make the thing, right? It all comes down to estimating expected future cash flows and required return. Now, the more complex the security is, the more difficult it is to come up with these expected future cash flows, right? But still, the principle that we're going to talk about here, the guiding principle is exactly the same. All right? So, let's start with talking about a bond. All right? And in doing so, before I get to my bond equation in just a second, let's just come back to our series of cash flows. What makes a bond so nice to deal with is that the contract between investors and the company specifies the timing of the cash flows. It tells us exactly when the cash flows are going to occur, the dates. I mean, if you go in the bond, it says, on this date, these are the cash flows. And it tells us the size of the cash flows, how much. So when you're dealing with a bond, a plain vanilla U.S. corporate bond, there's very little ambiguity about the expected future cash flows, right? I know the coupon payments. I know when they're going to occur, I know how much they are, and I know the face value when I'm getting it back. So I have a really good sense about, I know exactly what the future cash flows are. It's really this required return that makes it somewhat challenging. And it may be a lot of the bond trading that goes on comes down to our differences of opinion of risk. Right? If you think about trading of any asset, a particular financial asset, if we all have the same estimate of cash flows and return, there's no reason to trade. We all think it's worth the same thing. Right? If Clayton thinks it's worth 20 bucks and I think it's worth 20 bucks, great, we agree. Right? We're not going to trade, right? Unless I have a liquidity event and he gives me 20 bucks, right, or something like that. But there's not a lot of room to trade. The only trading that would happen is because of liquidity events. But as soon as we start disagreeing about expected future cash flows or a required return, now we have an opportunity to trade. Right? So if Greg and I say, well, you know, it's a bond, and so we both agree on the cash flows. But I look at all the risks and I say, you know, I need 10%. And Greg says, well, I actually only need 9%. Well, now we have an opportunity to trade. Right? There's a price at which maybe we can both be happy and decide to trade the bond back and forth. What we'll see later on with stocks is even the future cash flows, there's a lot of ambiguity about how much cash. So that's why you see so much more trading in stocks, because there's so many more differing opinions about how much cash flow a company's going to generate. Right? And the more we differ, the more different opinion, the more trading that's going to happen. Okay? Anyways, so let's think about this bond we have up here. Right? And what we can think about, again, I want to come up with a present value here. All right? Now the nice thing is we can, if we look at this using our Lego approach, if you stare along at that, we've got two things we know how to deal with. What does the coupon stream look like?
Cash flow.
Cash flows. What type of cash flows specifically? Was it, Mike?
Annuity.
Annuity, right? Same cash flow every single period, and it ends. Well, I know how to deal with that. right? That's the value of the stream of cash flows, right? And then what do I have here? I have a face value. What's that? It's just a lump sum cash flow, right? A single cash flow. I know how to do with that. If I want to know, I should be very careful here. The present value of the bond today, 0. Right? It's just a stream of cash. It's just an annuity plus a face value. That's what my bond's worth. Right? So that's our bond value formula. Right? We like to stick the R over here, maybe make it fancier than normally do it, right? But this first part here, we just bring the R back out. That is just our annuity formula, plus our lump sum of future cash flow formula. So I'm not teaching you anything else except put a plus sign between them. That's basically all that I'm doing here. Right? Don't tell anybody that I reduced my salary. But all they're doing is putting a plus sign between it, right? We're adding an annuity to a lump sum. That's what we're talking about. Okay? And that's all that this formula is doing. Now, when we do this on our calculators, it's even easier than this, because that row of buttons we had, that time value of money row, I think there's 5 of them. We were always using 4. Now we use all 5. Right? We have now 5 pieces to the puzzle. Right? If we want to know the present value, or PV button, and we'll do an example of this in a second. If we want to know the present value, well, it's a function of 4 things. Per period cash flow, which we call PMT. The discount rate, which we call IY. The number of cash flows in the annuity, number of payments in the annuity, we call that N. And that face value, which is our future value. That last payment represents the future value, that later cash flow. So if you have your payment, PMT, your N, your IYR, and your future value, if you know all 4 pieces, you can ask your calculator to solve for the present value. Okay? And just like before, if I know any 4 pieces, I can solve for the 5th. Right? So if I happen to know the price of the bond, but not the coupon payment, I can solve for that if I knew everything else. Okay? So we're going to be able to use our calculators to very hopefully quickly solve for the value of the bond. But before doing that, I just want to show how we get to how we got to the formula. Right? It's very simple. We just looked at the cash flow associated. And because a bond specifies cash flows exactly in the contract, we can easily write down the value of all kind of simple bonds. Any questions there? Let's do an example. So let's consider a corporate bond that has a 6 3/8% coupon. That's the coupon rate. It was issued on January 1st, 2015, and it matures on December 31st, 2019. Okay? So this is a what? 5-year bond, right? 15, 16, 17, 18, 19. It's a 5-year bond, right? The par value of the bond is $1,000. 90+% of U.S. corporate debt have a par value of $1,000. Okay? And again, that $1,000, if I buy one bond, that's kind of what they promised to pay me at maturity. Okay? The one notable example is Microsoft, when they decided to issue bonds for the first time at the depths of the credit crisis. They decided to be different and have $2,000 par value. But most bonds have $1,000 par value. Okay? The semi-annual coupon payment, right? So if I'm trying to figure out here how much I get every 6 months, so we talked about how we do that. Right, this bond pays interest every 6 months. I'm going to take my coupon rate, right, which is a 6.38%, 6.38%, which is what, 6 and 3/8 is what, 375?
Yeah, 375.
Since decimalization, you don't have to learn these things anymore. But anyways, so 6 and 3/8% is 6,375. Number of coupons per year, there's 2 of them because it's semi-annual. Multiply by the face value of $1,000. If you buy this bond every 6 months, you're going to get roughly $32. That's our coupon payment. And because the bond was issued on January 1st, the payments are going to be made every 6 months. So June 30th, December 31st are the trading days associated with those. You'll get to the actual coupon payment. Okay. So this is what you can see a timeline out here of what the cash associated with this bond are. Here's today, or was in January 1st, 2015. 6 months later, on June 30th, which is coming 5, you continue along until maturity, December 31st, 2019, where you again will get the 31,875 and you will be repaid the face value of $1,000. Question is, what would you pay for this bond on January 1st? We take a time machine back to January 1st. These bonds are going to be issued. What would you pay for one of these bonds? Well, we're simply going to use our present value of bond formula and plug in everything that we know. Okay. Oh, sorry, need one more thing. Sorry, the last thing that I need, I didn't tell you yet, was the discount rate, the little r. Right? And in the world of bonds, the discount rate, which always represents your required return, right? Discount rates, what do investors want, is the yield to maturity. Right? So the yield to maturity in this case is 5%. Right? So we're just told that. We have to be told that in this case, if we want to calculate the price. We have to be told the yield to maturity. So as of right now, investors are demanding a yield to maturity of 5%. I think I forgot to mention this early on, but just like the coupon rate, the yield to maturity is always annualized, like an APR, right? So we always know what we're talking about, right? So if you have a yield to maturity, it's always annualized, all right, in a kind of APR style. All right? So if I want to know the value of this bond at issuance, I'm going to use my formula and just plug in everything that I know, right? Per period cash flow, right? Big thing is we're working in semi-annual periods. Cash flows are every 6 months, so I'm working every 6 months, right? So my C is 31,875. That's my 6-month cash flow, right? So if I have 6 months cash flows, we talked about my R and my T always have to match, but I always have to the certain period I'm working with. So I have semi-annual cash flows, I have to have a semi-annual discount rate. All right, my yield to maturity, which is annualized, I divide it by 2. Right, so 2.5% semi-annual discount rate. Excuse me. All right. We go through this. What else do I need? 1 plus R, again, 2.5%. My T. T represents the number of payments in the annuity, number of cash flows with the bond. It's a 5-year bond that has semi-annual cash flows. 10 of them. I can just say 10. 10. So there are 10 of them, right? 2 every year for 5 years. So that my T is 10. My face value, as we said, is 1,000 that you're getting back at the end of the 5th year. But we're doing everything in terms of semi-annual periods. So I have a semi-annual discount rate of 2.5%. I need to discount that back 10 semi-annual periods to get to today. Right? And as the screen says, that means the value is 1,060. All right? How do we do that on a calculator? Just make sure we all get the same answer. As always, be clear. Right? And we feed in the 4 things that we know. It does not matter the order as before. One of the things I know is the number of payments in the annuity, and the coupon payments, the coupon payment itself, how much I'm getting every 6 months, the per period discount rate, and the face value. Okay? You put all that in and ask the calculator to spit out the present value. Okay? Now, in this case, as we talked before, the sign of the cash flows matter. And the way that I entered it, am I entering this from the perspective of someone buying this bond or someone selling this bond? Not everybody at the same time, please. Buying, they're positive, right? So those cash flows are, I put these in as inflows, right? They're positive. So the present value I'm getting will be negative, which indicates an outflow. I'm buying this bond, right? You could very easily put these in as negative. This would be the person selling the bond, and then the PV would be positive. You would get the money from selling the bond. Either way is fine. You get the exact same solution. It doesn't matter. Any questions about that? All right. That's a little. That's just So now let's assume, let's do this quick, we'll take a break in there. Let's assume that everything has remained the same, right? The company has issued these bonds. If you were buying these bonds, this is kind of a weird example where the coupon rate didn't equal the yield to maturity, but that is what it is, it's fine. You bought one of these bonds, you paid $1,060 for them, which was a fair price. You're not upset about that. It's exactly what you should have paid. And then the second you receive them, something happens.
That's the first example.
Right? Something happens such that the yield to maturity goes from 5% to 11%. First off, is this something that happened a good thing or a bad thing? A bad thing, right? Because before, investors were willing, 1 second ago when you bought it for $1,060, investors were willing to accept 5% as fair compensation for their risk. Something cataclysmic just happened in this 1 second that now investors are saying, I need 11% to feel good about owning this bond. Right? Now, that 5% is set in stone, as we talked about. The company does not have to pay anything more than that. That's what was agreed upon. But if I, as the one who bought this at a 5% yield to maturity, I'm sorry, the company agreed to pay 6 3/8%, not 5%. Right? The company agreed to pay 6 3/8%. That was the coupon limit, right? The coupon, they agreed to pay 6 3/8%. That's set in stone. That doesn't change. But if I now want to sell this 6 3/8% bond, right, and to anyone, so Brian wants to buy this from me, right, he needs to get his 11% return. The only way that we can trade is for the price to adjust. All the other features of the bonds are set in stone. The only way we can trade is for the price to adjust such that he will get his 11%. So the question is, what is the price now? Right? And so we go through the exact same exercise we just went to, but except we're now going to adjust the yield to maturity. Right? Everything that was contractually in the bond is the same. Coupon payment, that 6 3/8% coupon rate, stayed the same. Number of coupon payments, as I said, this happened in half a second, right? So that didn't change. 10 coupon payments left, right? There's $1,000 as the face value. That did not change. The only thing that changed was the yield to maturity. So instead of using the 5% and getting the semi-annual rate, we're now using the 11% and getting a semi-annual rate. Right? So we go through everything we did, we plug it into our calculator, and the calculator now spits out 825.69. Right? So that bond that I paid $1,060 for half a second ago, if I also, this cataclysmic event is correlated with my liquidity needs, right? So I need to sell this bond immediately. Right? I go to Brian, he says, absolutely. I'll pay $825.69 for it. And if we have the same information set, if everything, right? And I say to myself again, so we have no difference in opinion. We share the exact same opinion. I'm only trading because I need the money. So I also agree that 11% is the true return, the required return. I say, I'm okay. Right? I understand it. There you go. Here's the bond. Thank you for my $825.69. I go take care of my liquidity event. And as Matt asked before, I lost.
But if you do hold on to it, you're good.
If I hold this bond until maturity, I will make my 5%. Right? That's what I get. When I paid $1,060 for this bond and made this stream of payments, I get my 5%. Yep. Right? And now that if Brian holds this bond until maturity, he's going to get his 11%. Right? He's going to get the 6 3/8% coupon rate, which is fine. Right? But he's also going to get some price appreciation. He's paying $825.69, and in 5 years, he's going to get $1,000 back. So when you bake all of that together, the coupons he's getting and the return of the par value, by paying $825.69, he's going to exactly get the 11% yield to maturity that he wants. Investors get the return that they demand. Okay? So the price is going to adjust, right, to reflect the yield to maturity. And so from this, you can see, and I think Mike, you brought this up earlier, this well-known pattern, just cut off, between rates and bond value. Rates go up. And when we talk about rates, what we're talking about here is the yield to maturity. Right? As rates go up, the price goes down. Right? The price adjusts so that we can trade. The coupon rate remains the same. The face value remains the same, and if we're not talking about any time lapse, the number of coupon payments remains the same. So the only lever that can adjust for us to trade is the price.
The way that conceptually makes me think of this is if I get 5.5% bond, right? The market now opens it up. The investor can go and get somebody else.
Yeah.
So you need to pay it.
Yeah, exactly right.
I have to go over that.
That's right. Yeah, your coupon rate is somewhat irrelevant to what they want. Right? What they want is a function of information that's out there, right? And then, yeah, exactly. That's right.
Drops and price drops down.
Yep. Right. So if you own right now where yields are super low historically, if you own a coupon bond that you bought back in the early '80s that has a 15 or 20% coupon attached to it, that looks really tasty right now, right? That's a lot of yield. So guess what? You got to pay a lot for that bond. And guess what? You're not going to get 20%. You're going to get your 2%. Because the price is going to be so high that you're going to have to pay to get that 20% bond. Yeah, you're right. You're going to get those coupon payments. Now, why the hell that company didn't refinance is a side point. But anyways, you're going to get your 20% coupon payment, but you paid such a high price at the end of the day, your return is just going to be the 2% you should be getting right now anyways. Right? Now, the last thing, and we'll take a little break, a little bit more jargon. As I said before, the relation between yield to maturity and coupon tells us something about where the bond is trading, its price level, right? So what we say is, if the yield to maturity exactly equals the coupon, the bond is trading at par. What that means is the price equals face value. Okay? So if the coupon rate, which is what the company promises to pay, exactly equals the yield to maturity, what investors demand. So investors are getting exactly what they demand. The bond trades at par. The price equals face value. Okay? Let's say an other example. If the yield to maturity is less than the coupon, right? So in this case, what investors is demanding is less than what they're getting. They're getting more than they need, right? This is back to the 20% bond example. I only need 2% for the bond as a 20% coupon. The bond is trading at a premium. The price is going to be high. Investors are getting a higher rate than they demand in terms of the coupon rate. The price is going to be high such that they always get their yield to maturity. And in the other case, which is cut off, if the yield to maturity is greater than the coupon rate, right? So what I demand is more than what I'm actually getting, the bond is going to trade at a discount. The price is going to fall. Right? The price is going to fall such that I get that yield to maturity that I'm demanding. Right? So by just looking at the relation between yield to maturity and coupon, we can say something about where the bond is trading relative to its par value. Okay? Any questions about that? Let's take a little break. We can do that. So we'll take 10 minutes. Let's get back here at 3:30. I got a good bit to I got a good bit to get through. Oh goodness. Okay, so I got a good bit to get through still. So I'll try to get through. We're going to get through that. We'll talk about yield to maturity next and move quickly into stock. So we need to start right at 3:30.